October 1909, the noise came first, not the sound of collapse, but the sound of disbelief. Phones ringing without answers, papers crumpled in trembling hands, voices rising, then breaking, then dissolving into something quieter, something more. Dangerous. Panic. On the floor of Wall Street, men who had built empires in numbers suddenly found themselves drowning in them. Prices fell not like rain, but like gravity had been switched on for the first time. Fortunes didn't shrink. They disintegrated, and history remembers this moment as a tragedy, a collapse, a failure. But there is a question that almost never gets asked because it disrupts the entire narrative. If billions were lost, who received that money? Because money doesn't vanish, it moves. For every seller in desperation, for every collapse in price, there is someone waiting beneath arms open, calculations precise, and somewhere away from the noise. There were people who were not panicking. They were watching. Imagine two individuals, one a clerk, modest, savings accumulated over years, drawn into the market by the promise of easy prosperity. He watches the ticker. At first confusion, then fear, then a kind of silent horror as the numbers keep falling. He tells himself it will recover. It always does until it doesn't. Now imagine another dot. No shouting, no rushing, no visible urgency. He had already considered this outcome not as a possibility, but as an inevitability. While the crowd celebrated rising prices, he studied the structure beneath them. While others borrowed to chase growth, he conserved, waited, positioned, and, when the market turned, he didn't react, he executed. This is the paradox of every financial collapse. It feels like chaos to those inside it, but to some, it unfolds like a script they've already read. So what was 1929? Really an accident? Or a moment where two different understandings of the same system collided, one emotional, the other structural? History tells us about the losses, the suicides, the despair, the Great Depression that followed, but it rarely lingers on the other side of the equation. The beneficiaries, not because they didn't exist, but because they are harder to see. They do not appear in crowds. They do not make noise. Their presence is revealed not in headlines, but in outcomes. Assets change hands, power consolidates, and when the dust settles, the world looks different, not just poorer, but rearranged. Here is the uncomfortable truth. Crises are not equal. They do not distribute pain evenly. They do not reward everyone equally. They are filters, and filters by design. Separate so, the real question is not simply what happened in 1909. It's this: who understood what was about to happen before it happened? Because if you can answer that if, you can identify the people, the institutions, the structures that operated above the chaos, then the crash stops. Looking like a disaster alone, it starts to look like something else, a transfer. And if it was a transfer, then from whom? To whom? To understand that, we have to go back. Back to a time when everything looked perfect. Back to the moment just before the fall, when the illusion was strongest and the cracks were already there. Hidden in plain sight, the 1920s did not feel fragile. They felt unstoppable. It was an era drenched in confidence factories, expanding cities, electrifying technology, accelerating. Radios brought voices into living rooms. Automobiles transformed distance into something conquerable. Industry was not just growing, it was redefining what growth meant, and somewhere within this expansion, a new belief quietly took hold, that the system had evolved beyond collapse. Stock tips moved like whispers between friends, then like currents through entire communities. The market was no longer an abstract machine, it was a shared opportunity, a gateway, a promise. Ordinary people entered for the first time not cautiously, but eagerly. Why wouldn't they? Prices only seemed to go one way up. But beneath this, optimism. Something more delicate was forming. A dependency, not just on growth, but on the continuation of growth. Because increasingly, people were not buying assets with what they had. They were buying with what they didn't. Single quotes. 2. Margin, a simple concept with profound consequences. Borrow money to buy stocks, amplify gains, multiply opportunity, but also multiply risk. At first, it felt like leverage. Then it became normal. Then it became necessary. Because when everyone else is borrowing to buy, the person who doesn't falls behind. This is the paradox of prosperity. The stronger it appears, the more it demands participation, and the more fragile it becomes. Financial institutions didn't resist this behavior. They enabled it to credit expanded. Lending loosened. Risk became diffused across layers, so complex that it no longer felt like risk at all. It felt like momentum, and momentum is seductive. Even those who understood the danger found themselves pulled into it not because they believed in it, but because the system rewarded belief. This is how bubbles form, not from ignorance, but from incentives. Everyone sees the rising tide. Few ask what happens when it stops. And the signs, they were there. Valuations stretching beyond reason. Debt accumulating beneath the surface. Speculation replacing analysis. But the most dangerous element wasn't financial. It was psychological. Confidence had become self-reinforcing. The more prices rose, the more people believed they would continue rising. And the more they believed, the more they acted, pushing prices higher still. A loop closed, tightening, unquestioned. And within this loop, there were individuals, bankers, policymakers, industrialists, who saw more than just the surface. They understood the mechanics, the fragility. But systems are not guided by awareness alone. They are guided by incentives. To slow the boom would be to interrupt prosperity. To restrict credit would be to limit growth. To warn the public would be to challenge the very confidence that sustained the system. So the machine continued louder, faster, brighter, like a party that no one wants to end, even as the floor begins to crack beneath it. And here is the unsettling question. If the cracks were visible, why did no one stop it? Or perhaps more precisely, who chose not to? Because recognizing a collapse is one thing, preparing for it is another, and somewhere within the noise of optimism, there were those who were not celebrating. They were calculating, waiting for the moment when confidence would fracture and everything would change. The collapse did not begin with a single moment. It began with hesitation, a subtle shift almost imperceptible. Prices stopped rising as quickly, then they stalled. Then, quietly, they began to fall. At first, it felt temporary, a correction, but markets are not governed by value alone. They are governed by belief. And belief, once shaken, does not stabilize gently. It fractures. Margin calls came first. Investors who had borrowed to buy stocks were now required to repay part of their loans. But they didn't have the cash, so they sold. And selling pushed prices lower, which triggered more margin calls, which forced more selling, a chain reaction, not mechanical, but psychological. Fear spreading faster than information, faster than logic. This is the paradox of markets. They are not destroyed by weakness alone, but by the perception of weakness. Even strong assets fall when confidence disappears. And in 1929, confidence didn't just disappear. It inverted. What was once seen as safe became dangerous. What was once inevitable growth became inevitable collapse. And in this inversion, something extraordinary happened. Power shifted, because while most participants were leveraged, trapped within the system's momentum, a small minority stood. Outside of it, liquid. Cash. In normal times, cash is passive. It waits. It seems inefficient. But in a collapse, cash becomes something else entirely. It becomes opportune, preferring freedom, while others are forced to sell. Those with liquidity can choose. They can wait for prices to fall further, or they can begin acquiring strategically, assets that once seemed expensive suddenly become accessible. Companies, land, infrastructure, not at their peak value, but at their most vulnerable. This is where the asymmetry reveals itself. Most people were playing the game of expansion, buying into growth, believing in continuation. But a few were playing a different game, preparation, and preparation is invisible until it isn't. Short selling, betting against the market, told some to profit directly from the decline. But even beyond that, the real advantage was not in predicting the fall, it was in surviving it. Because survival, in a collapse, is not neutral, it is leverage. When others are eliminated financially, structurally, you are not just preserved, you are elevated. This creates a strange dynamic. The system punishes urgency and rewards patience. It forces the majority to act at the worst possible time, while allowing a minority to act at the best. Not because they are smarter in the moment, but because they positioned themselves differently beforehand. And this raises a deeper question. Were these individuals simply fortunate, or did the structure itself favor those who could afford to wait? Because if the system inherently rewards liquidity, foresight, and detachment from collective emotion, then the outcomes are not random, are patterned, and patterns, once understood, can be anticipated. But to see the full picture, to understand who truly profited, we have to move beyond individuals, beyond isolated decisions, and into something larger. Network, a system of power that did not exist within one market but across many, connected, interdependent, global. The crash of 1929 did not stay in New York. It couldn't, because by that point, the world was already connected, not just through trade, but through capital itself. Money flowed across borders like an invisible current. American loans supported European recovery after the war. European banks relied on American investment. Nations were bound together not by geography, but by financial obligation. And this created a paradox. Interconnection made growth more efficient, but it also made collapse more contagious. When the U.S. market began to unravel, it didn't just affect domestic investors, it disrupted the entire web. Credit retreated, credit tightened, confidence already fragile began to collapse globally. European banks, many still recovering from the aftermath of war, found themselves exposed. Their balance sheets, tied to American capital, suddenly became unstable. Withdrawals increased, liquidity vanished, and the crisis spread from markets to banks, from banks to economies, from economies to societies. This is the hidden architecture of globalization. It amplifies both prosperity and vulnerability, and within this architecture, not all actors are equal. Some are deeply embedded, dependent on continuous flow. Others are more insulated, diversified, reserved, anchored in assets that do not fluctuate with sentiment. Gold, for example, became a form of stability. Nations and institutions with substantial reserves found themselves better positioned, not immune, but resilient. And resilience in a global crisis is power. Because as weaker institutions fail, banks collapse, businesses dissolve, governments struggle, stronger entities do not simply survive. They expand, they acquire, they absorb. This is the second layer of the crash, one that operates quietly, beneath headlines. A consolidation, not just of wealth, but of influence. Because when entire systems weaken, the entities that remain intact become more than participants. They become anchors, and anchors attract control. This raises a deeper, more unsettling question. Was the crash merely a financial event, or was it a restructuring of global power? Because if the outcome consistently favors those with diversification, reserves, and cross-border positioning, then the system itself may be designed not intentionally, but structurally to reward scale, and scale, once achieved, reinforces itself. The bigger you are, the more resilient you become. The more resilient you are, the more you can acquire during crises, and the more you acquire, the bigger you become. A loop, not unlike the one that created the bubble butt. Inverted. And hidden within this inversion is the answer we've been moving toward, because the true beneficiaries of 1929 were not always visible individuals. They were institutions. Networks. Structures that emerged from the collapse. Stronger than before. But this is only part of the story, because to fully understand what happened, we have to confront something more uncomfortable. Not just who benefited, but why the system allowed it. What if the crash was not simply a failure? What if it was a filter? This is the perspective most narratives avoid, because it reframes tragedy into mechanism. The same event that destroyed wealth on an unimaginable scale also created opportunity. On a scale just as vast, but not for everyone. For those with access to capital, the collapse was not an ending, it was an opening. Prices fell, but value did not disappear. Land still existed, companies still produced, infrastructure still functioned. What changed was ownership. Assets moved from those who could no longer hold them to those who could, and this movement was not chaotic, it was directional. Because when panic sets in, decisions are no longer strategic, they are reactive, urgent, emotional, and emotion in financial systems. It's predictable, it can be anticipated, even utilized. This is the darkest paradox of all. Panic is not just a consequence of crisis, it is a resource within it. While the majority is driven by fierce selling to escape losa, minority operates without that constraint. Not because they are immune to fear, but because their position allows them to ignore it. Liquidity provides distance, and distance provides clarity. Major financial institutions, investment groups, and wealthy individuals did not need to act quickly. They needed to act precisely, acquiring assets not at their perceived value, but at their most distressed. This is not a story of conspiracy. It is a story of asymmetry, access to information, access to capital, access to time, three variables that determine outcomes not just in 1929, but in every crisis. And here is the uncomfortable implication. If these asymmetries persist, and they do, then the pattern persists as well. Crises do not just happen to systems, they reveal them. They expose who is vulnerable and who is positioned, and more often than we admit, they transfer wealth upward, not by design in a conspiratorial sense, but by design in a structural sense, because the system rewards those who can endure volatility and penalizes those who cannot. So we arrive at a question that is less historical and more existential. Is this a flaw, or is this the system functioning exactly as it was built to function? Because if crises consistently produce the same outcome, consolidation, concentration, redistribution, then perhaps they are not anomalies. They are mechanisms. And if they are mechanisms, then they are not confined to the past. They are templates waiting. The distance between 1929 and today feels vast. Different technology, different institutions, different language, but beneath these differences, the structure remains familiar. Debt expands, confidence rises, innovation accelerates, and with it, speculation follows. It always does, because progress creates belief, and belief creates risk. Today's markets are more complex, more interconnected, more data-driven than ever before. Algorithms replace intuition. Information travels instantly. Risk is modeled, quantified, distributed, and yet, human behavior has not evolved at the same pace. Greed still amplifies during growth. Fear still accelerates during decline. And systems, no matter how advanced, are still built on human decisions. This creates a paradox of progress. The more sophisticated the system becomes, the more it disguises its own fragility. Leverage still exists, just in more intricate forms. Bubbles still form just around new assets. Interconnection still spreads risk just across larger networks, and the same pattern begins to emerge. Expansion.confidence.overextension. Then hesitation. The early signals are always subtle, easy to dismiss, rationalized away, until they aren't. The question is not whether another collapse will occur. History suggests that it will. The question is, who is preparing for it? Because just as in 1929, not everyone is playing the same game. Some are participating in growth-riding momentum, embracing risk. Others are positioning quietly, reducing exposure, increasing liquidity, studying patterns, not reacting to the present, but anticipating the shift. And when that shift comes, because it always does, the experience will not be uniform for many. It will feel like chaos. For a few, it will feel familiar, expected, even necessary, because within every collapse lies the same hidden structure. Loss and opportunity, and the difference between them is rarely timing alone. It is understanding. Financial systems are often described as machines. Cold, logical, mathematical, but they are not. They are reflections of human behavior, of collective belief, of the tension between fear and desire. Markets rise because people believe they will rise. They fall because that belief breaks, and within this cycle, something deeper reveals itself. A paradox that we create systems to control uncertainty, yet those systems amplify it. We build structures to generate stability, yet they produce instability, because at their core, they are not governed by equations. Alone, they are governed by us. Our optimism, our impatience, our need to participate when others are succeeding, and our need to escape when others are failing. And this creates inequality, not just in wealth, but in experience, because access is not equal. Some have information earlier, some have capital longer, some have the ability to wait, and time in financial systems is perhaps the most underestimated asset of all. Those who are forced to act quickly due to debt, pressure, necessity are often pushed into disadvantage. Those who can wait, observe, endure, are given something rare. Perspective. So the question becomes less about predicting crises and more about positioning within them. Is security found in avoiding the system or in understanding its cycles deeply enough to move with them? Because if collapse is not an exception but a recurring feature, then perhaps the goal is not to escape volatility, but to recognize it, to see it forming before it becomes visible, and to choose deliberately where you stand when it arrives. So, who actually profited from the crash of 1929? Not a single name, not a single group, but a pattern. Those who understood the system not just at the surface level, but at its core, those who saw beyond rising prices into the structure beneath them, those who held liquidity when others held leverage, those who remained patient while others were forced to act, because in the end, the crash did not simply destroy wealth, it redistributed it from the unprepared to the positioned, from the reactive to the strategic. And this is the final paradox. The event that appeared as chaos was, for some, clarity. The moment that felt like collapse was, for others, opportunity. And history does not repeat itself in exact detail, but it echoes again and again. The next crash will look like chaos to most, but to a few, it will look like something else entirely. Opportunity? The only question that remains is when that moment comes. Which side will you be on?